Good afternoon. Stock market trading session 12. We have Vince here. Good afternoon, Vince. This is Apple. I'm doing good. This is Apple behind me. This is today. Can you see? It starts low in the morning, it comes up in the afternoon. So today you're going to do your Harvard presentation. Basically explain the systems, the principles in a short presentation. Are you ready?
I'm ready.
Start off with that. We can cover some more stuff after. Okay, ladies and gentlemen, this is Vince, esteemed colleagues, associates, enlightened students, and faculty. This is Vince. Go ahead.
All right, Harvard presentation. This is how we retire into the stock market. It starts by having a strict criteria. We only trade the best stocks. We only trade the best stocks. We don't waste time. We don't trade brand new stock. We don't trade new stocks that are in the market. We don't trade stocks that are going down. Some of our criteria for what stocks that we trade, they've got to have a good long-term trend. They've got to go from bottom left to top right, like Netflix, Apple, Nike, things like that, stocks like that. They've got to go up over time. They've got to have high volume. Volume is consistency. If a stock dips, it's going to get bought up. So having a criteria for volume, like for me, I only trade something if it has at least 1 million shares traded a day. Got to have another sign for good stocks are stock splits. Never trade stocks that do reverse splits or they're coming down. We trade like the stocks that like Apple just did a 4-for-1. Tesla did a 5-for-1. Stock split history.com, I believe it is. Stock splits a good PE. Good PE is earnings per share. We got to have positive PE. You told me several weeks ago a good PE is 20 to 100. I wrote that down. Dividends aren't the most important thing, but it's a benefit. If we're holding a stock, it's good to get those dividends. We don't trade any stocks with a small market cap, or as Eric says, anything that could be a house in Malibu, I think it is. We trade high market leaders. That's what we deal with. Once we trade these stocks, we write covered calls on them. We get 3 to 5% every 3 to 5 weeks, every 3 to 6 weeks. When the stock's going up, we sell covered calls. When the stock comes down, we can sell puts on it. We can buy the dips and sell the peaks, like on Starbucks. Starbucks dips, $3 to $5 here and there. It's a good stock to do that on. And let's see, those are the basics of how we retire into the market.
Very good. You have graduated, my friend.
I was brief.
Graduated. Yeah, graduated the course.
No, get him out of there. Exactly. He about to sit there and jump
Did I tell you about Mr. Morgan?
Where you going?
Yeah,
Mr. Morgan's the guy who you're working for. You're trading $1 million account. And he comes to check on you. You don't really want him to come to town too often because when he comes to town, he sacks people. So you just kind of want to keep him in New York and trade in your own city and make money. People who lose money, they end up getting sacked. So he's the guy who has his name on the building, who his name is on your check. He has old money, maybe from Texas. He has the Texas thing instead of the tie, the hat. So So he's in there. He's in the audience. He's like clapping. He doesn't trade himself. He hires traders to make money. So you're always thinking about Mr. Morgan. Mr. Morgan, my friend, that's you. That's your alter ego. That's your subconscious that you wake up with in the morning that questions yourself. Am I successful? Am I doing this right? Will I make it?
We only trade the best.
Trade the best. You got to prove to Mr. Morgan that you can make money, that you can be successful, that you're a winner, you know. So that's good. So on the cover calls, we go 3 to 7 weeks. And on the volume, 1 million is good, but 2 million plus is even better in the volume. Dividends, we like to get, let's say, 4 to 8% dividend per year plus. Am I going too fast for you?
No, dividends 4 to 8% a year.
Plus, yeah. And you said PE. Yeah, dividends 48% a year plus. You said PE 20 to 100. It's 20 to 100 plus. Let me explain that. I get a lot of advanced traders that that disagree with that. But what that is, that's a sweet spot. Like if you have a company with like a 10 PE, that means they're actually making more profit than a company with a 20 PE. 20 PE is a higher PE, it's less profit per share. 100 PE is like what they say overvalued, you know. It's trading at a higher multiples, you know. But if you look at, Netflix, it's like a 60 or 80 PE. If you look at these stocks that are climbing like crazy, they have a higher PE because they're trading at multiples, higher multiples. So the sweet spot for me, when I do these technicals, when I study the markets over the months, I look at these stocks month to month, year to year, is 20 to 100 plus, and this is the higher chance of getting great share growth. But 20 to 100 plus, highest chance to get great share growth. I'll put here sweet spot.
Higher as opposed to like 19 and under PE.
Right. If you have a stock that has a 5 PE, they're making good return, but there's something wrong. It's too boring. It's like maybe that's like Ford or something like that. Maybe it's something like Bank of America, who doesn't really have a way to grow because they're already as big as they can really get. They can really handle themselves. Netflix, though, can grow, can double. Apple can still grow, believe it or not. Even though it's the biggest stock, it can still grow. Amazon, I'm talking about getting the drones out. This whole COVID thing kind of teaches us that the business can change, the market can change. So if you have a stock like Amazon that's already doing great, you have people that are quarantining, that are not going out because everything is closed. A company like Amazon is obviously going to do great in that environment. It's going to take advantage of that situation. It's going to excel because the environment is changing. People are staying home more, they're working from home, or they're not working, and they get everything delivered to their door, whatever they can afford. So that's how fast the business changes. And if you invested in restaurants, or if you have invested in Carnival Cruises, you'll see that those stocks are down. Gasoline, Exxon is down. Transportation stocks, entertainment stocks are down. So, but Netflix, because it streams at home, is up. Or better way to put that is it's maintaining, and the price is doing good. right? So the business changes all the time. In this case, this is a good example. So I wouldn't invest in these companies that have come down. There's one, Dave and Buster's. Dave and Buster's, it's like an entertainment. It's like a restaurant. They have like the arcades inside there, the games. You can play games and have food. But they've been closed for how many months has it been? They've been closed for 8 months. So where's the business? They're about to go out of business. I don't know that. I wouldn't bet that they're going to come back. I wouldn't bet that this whole thing's going to go away. You know, whether it's manufactured or conspiracy or it's true, people believe it's true. It's on the news. The cities are all shut. They're all curfew. You know, shut down. No gatherings. You know, even restaurants have to eat outside. And if you didn't have a restaurant that had a big ass patio that was already relying on a lot of to-go food, you're basically out of business. Starbucks is doing okay or they're doing good because they have the drive-through line down the block. So, you know, McDonald's, you know, drive-through line down the block, right? So these companies can survive. The other companies cannot. Mom and pop restaurant out of business. So you have to change with the times. You have to change with the business environment. Any questions on that?
No, you could use that same analogy with stocks, like the little stocks, small cap, they don't survive in a volatile market, you know?
Right, exactly. So so let me say this: if you're gonna go into a bear market or a stock market crash or a recession, those small companies don't have the capital, don't have the income, don't have the manpower to make it to compete with these other big companies. So the big companies, whenever there's a problem, where they got to pay more taxes, or they get sued, or they get a recession, they just tighten their belts. They just lay off. So if we have 100,000 employees and go to 80,000, lower their payroll, cut down the factories that don't make as much, close the stores that are making less, and keep the stores open that are the main stores, like let's say Starbucks, you know, Chipotle, also a good one. And they're going to be able to survive because they have more income, they're bigger, they're more established. Those small companies just get destroyed because, you know, look what happened with, just you know, Walmart in the last 20 years. That killed a lot of mom and pop shops. Just the competition. Walmart, they get the stuff cheaper. They put all the stuff in one area. Costco, same thing. They can get the stuff cheaper. They put it all in one place for you. So all these mom and pop shops went out of business. Most of them, some of them. And then Amazon, to another degree. You know, Amazon's bringing everything to your door. Even better, don't even have to shop. Just open the front door. You know. So yeah, so enough on that. What are your thoughts on that?
No thoughts, man. It's good stuff, though. Good
So
to know and be reminded.
We're looking at these companies. Let's say let's put a few stocks down. Starbucks. You okay with that? Nike, Chipotle.
Yeah.
Starbucks is SBUX. Nike is NKE. Chipotle is CMG. Apple AAPL. And let's do one more. Give me one more.
How about Square?
SQ. Good. So Square does credit cards. On your phone, you can get a little attachment. You can take credit cards on your phone, so it makes the independent entrepreneur, a business person. You don't have to have the big credit card machine. You know, you don't have to have a storefront. You can just do business. I got lost you for a minute. Welcome back.
Yes.
You there?
I was just getting ready to text you.
So we have a few of these stocks. Can you quiet down a little bit? Quiet down. You have a few of these stocks that are great, I think, and they're doing great. And you invest in them, you'll do great. You said long term. That's a 10-year chart. 10-year. We don't really want to take chances with stocks that have not passed the 10-year mark. We just can't take that kind of chance. We go with like you say, the tried and true. We don't invest in bright ideas. We invest in well-established businesses and business structures. If we're in, let's say, Apple,